Welcome back to another episode of Policy and Profits. Thank you so much for joining us again this week. I'm EJ Antoni. I like to play an economist on TV, but I am joined, more importantly, by the one, the only Anthony Esposito, trader extraordinaire with more than 17 decades of experience on Wall Street. Anthony, how are you doing, sir?
I'm doing well. Having a horrible hair day, but I'm doing well. Thank you very much. It's funny. My oldest son called today and was asking me about something for college. And he said, "What year did you graduate again? 1929 or 1930?" So the fact that you're making fun of how old I am, I appreciate. Good timing on that one. Good delivery.
Brutal.
So I told him it was 42. I told him the truth, 1942.
Back in the war. Yep.
How's everything going your end?
Oh, hey, we are hanging in. It's been another crazy week of data releases. It's been a rough one for the consumer, especially as we start going through these numbers. Right, we start digging into the data. It is shocking, and a lot of this is not new. Right, so much of the data we get, as you know, Anthony, is always it's always backward looking, but sometimes it's very backward looking. In other words, it takes many months to actually get this data compiled, to put it into some kind of report that's a meaningful product, right? We're up right now. This is from the Philadelphia Federal Reserve Bank. And basically what it shows is that the percentage of accounts, the percentage of people with credit card debt that are actually able to make minimum payments, that's getting worse and worse. In fact, the number of people who all they can make is minimum payments, that's obviously going up. But we're also seeing the number of people who can't even make minimum payments go up. So more and more folks are just doing the bare minimum, and more folks aren't even able to do that. So it's really shocking what happened over the last 4 years, right? You look at everything Biden did, how much inflation went up, but then also how much interest rates went up. So inflation going up means people can't make ends meet. They're putting more and more stuff on the credit card. That's obviously bad. But it's not the end of the world as long as rates stay low and the financing charge on those accounts is also relatively low, right? This is part of the reason why, for the first couple of years of the Biden administration, the national debt was actually not that catastrophic because the interest payments to service that debt were pretty low given how low interest rates were. The problem was then when you combine that deadly scenario of high debt and high interest rates. And it's just as true for the government as it is for the consumer. So what has happened to the consumer? Well, as you start not only exploiting credit card balances, but then credit card interest rates, today they're at or near a record high, depending on how you want to measure it. Now you have these incredibly high balances and incredibly high interest rates, and you're paying over $300 billion a year just to service outstanding credit card debt. That's not a dime towards principal. That's not paying the darn things down. This is just the interest. And unfortunately, a lot of accounts basically have like a reverse amortization going on right now. In other words, the minimum payment that people are making in some cases doesn't even cover all of the finance charges. And so even if you're not adding any more to the balance, you're still seeing the old finance charge, some of that get rolled into the balance. And so the balance keeps growing. Again, even though you're not even spending more. So looking at this chart here, you can see what Biden inherits is basically very low number, and it just absolutely shoots up. So a small percentage of people were only making minimum payments, and today it's very large. And this is unusual. Normally, as the interest rate goes up on credit cards, people tend to pay more than the minimum because it's getting so incredibly painful. They're trying to get their debt paid down. Unfortunately, today we're seeing exactly the opposite because of, going back to what we said earlier, the desperate straits that the consumer is in right now. And this is, this what we're looking at here is actually from the third quarter of last year. We can anticipate it was even worse in the fourth quarter. And unfortunately, I don't think there's going to be much progress made right now in the first quarter of 2025. And now this is really starting to hit the consumer spending numbers for a very long time. And we've talked about this a lot, Anthony. How long can the consumer keep going here, right? At what point is the consumer going to hit the wall? It looks like it's happening right now. Increasingly, folks are putting so much money just to financing debt, they don't have anything left over to actually consumer spend, quote unquote. And that's even more so true today as Trump with Doge, as they start going through the budget, and getting rid of these different transfer payments, a lot of which were fraudulent. So the transfer payments, and this is timely today because we also just got the latest revisions to GDP. These transfer payments are basically government spending, but we end up counting them as consumer spending. So let's say the government takes $1 from you, Anthony, but they give it to me as a form of welfare, and I go out and spend it. I mean, really, that's government spending, right? The government is taking from you and allowing it to be spent somewhere else. But we don't count that as government. We actually count that as private consumer spending. And so you start taking all of that out as you start icing those payments. At the same time, you're reducing government spending, and the consumer has to cut back their own spending because of their debt constraint. I mean, that's a recipe for a recession, at least on paper. And that's because of the way we calculate GDP. So, unfortunately, a lot of the chickens, I think, are now coming home to roost. The consumer has been feeling pain for a very long time, but it's now just showing up in our official quote unquote metrics.
This is crazy stuff. Like when you think about just anecdotally, and I really like to try and pay attention to all the little things that go on and the newspaper articles, the headlines, just those dumb stories you hear about. Back in '08, I remember there was a $10,000 or $100,000 pizza in Saudi Arabia, and that pretty much marked the top, ironically, of the economic cycle. And recently I saw, right along with this, I think it's Klarna is one of those interest-free, no credit check credit companies. They're actually enabling you to order Grubhub or Uber Eats and not pay for the food when you get it. You can pay for installments. So if we're at a place where people can't afford a $12 taco or whatever, I mean, the prices are crazy anyway, but if you can't afford to order McDonald's, have it delivered, but you're going to need to pay in installments now, like where are we? What does that say about the consumer? And what does that say about the fact that somebody thought that service was actually necessary? I mean, I went on the other day and I bought a pair of pants, true story. And, it pops up right away. Do you want to pay in full or do you want to, pay in, 4 easy payments of $20 each? And I want to buy a pair of pants. Like I want to, back in the day, like my poppy, my grandfather the old timers used to call it, I would buy it on time. And they'd go down to the bank or they'd go right to the shop and tell the shop owner, because it was in the neighborhood, I'm going to buy this washing machine for my mom or my wife. I'm going to pay it on time. I'm going to come in every Friday when I get paid. I'm going to give you $5. And in 10 weeks, you'll be paid. Like those things made sense, right? But if you can't buy a cheeseburger and fries and a shake without paying for it over time, I mean, that's a really bad sign. And when you look at, as you said, you look at interest rates, you look at the level of consumer debt out there, and you look at how pressed the consumer is. I mean, obviously, if they're only making minimum payments, those principal balances are, actually going up, not going down with those payments. And let's be honest, people are continuing to use the credit cards because they need to. And then as you talk about those transfer payments going away and that artificial growth from government spending going away, over the term, as we go through this, we'll be better off. But it just seems very unlikely that we're going to escape a recession and that the consumer is going to just continue to skip along. You had another great chart out, and I think we have it on housing, because directly related to the consumer spending and health, you have to take housing into account, right? 70% of the country or something around that number, 70% of the country, their major asset is their home. It's not the stock market. It's not bonds. It's not precious metals. It is their home. What does housing look like? Go through this with me, because this is important.
Not good, unfortunately. We continue to see low non-performance, as they call it. So that's the default and delinquencies ticking up. And I think one of the ways in which the stress of the consumer really has been hidden for a while has to do with the reporting standards. And so this applies to both housing as well as student loans. So if we stick with housing for a second, there have been lots of instances where people, although they're way behind on payments, that isn't necessarily getting reported to credit bureaus. In other words, it's not actually affecting their credit score, and they're not being counted, quote unquote, as being behind on their payments, even though they really are and have been since COVID, actually. They still haven't caught up. It was 5 years ago. It's even worse when we look at when we look at student loans, where over a year ago now, I think it would have been October of 2023 was when people had to start paying again on their student loans, except if you were not making payments, if you were falling behind, it was not going to get reported to credit agencies. And this was advertised. So people were basically told, look, don't worry about making payments. Okay. A lot of this was because they were getting promised student loan forgiveness and other things. But whatever the case, the fact remains that none of this was actually getting reported to the credit bureaus until the fourth quarter of last year. And because a lot of these things are done on a quarterly basis, that means it's not actually going to hit the tape until this quarter, right now. So we're going to find out basically with the next series of credit reports just how many people are behind on their student loans. I think there was one estimate by the Federal Reserve Bank of New York that a lot of young people are going to see their credit scores take a hit in the triple digits. They're going to lose 100 points or more off their credit score because they have been so behind on so many payments for so long. I mean, that's scary. It's going to help, I think, reveal. It's going to drop the curtain on just how bad of a shape a lot of these consumers are in. And when we look at something like housing, it's amazing how many people still are not current yet on their mortgages. And what's scary is that usually rises, as you can see in this chart. That will usually rise with the unemployment rate. In other words, people keep making payments on their house until they lose their jobs. This was really the thinking going into the mortgage meltdown and the global financial crisis, right? People thought of mortgages as essentially a very boring commodity. Yeah, this is something that people always make their payments on. Well, until oil hits $145 a barrel, right? And obviously there were a lot of other concerns. There were a lot of other considerations. People were buying way more house than they could afford. For example, people kept thinking that they could just continuously refinance. They had these crazy mortgage products where you could borrow the entire house, 100% plus the closing costs, and even some other crazy schemes. Whatever the case, the scary thing is, Anthony, that we've seen the last several years, and that I think is illustrated well in this chart, is that you're starting to see the delinquency rate rise even without people losing their jobs. And so even though folks are still working, they're not able to stay current on their mortgage. And again, this is before all of the delinquencies hit the tape, before we get a better sense of just how many folks are in fact behind.
Yeah, I think if you look at this is exactly, I say it not jokingly, but it's just a phrase that I use. This is like this is part of the cleanup in aisle 7 that President Trump and the administration are dealing with. As you see, the consumers start to fall because the numbers are fake and they're going away, and the state of the consumer, the health of the consumer, is not what it looks like it has been. And you can quantify that. It's not just a political argument. You can quantify that. And then if you start to look at these delinquencies, you can clearly see that there's a lot to clean up in the underlying economy, in the private economy, what people's households look like. And you're right, as the unemployment rate, if it starts to tick up and there's any kind of slowdown because of all the other factors that are being cleaned up, these delinquency rates should, as they historically would, they should start to creep up too. So you're going to have more delinquency rates on mortgages, which is a problem in a housing market right now that's kind of barely just holding on. It's a very odd market, very low sentiment, very high prices, and higher rates on the mortgages, even though the Fed cut. And we've talked about that before. So housing market, not great. Consumer sentiment is actually falling off, and the state of the consumer, not great. All these things are part of the cleanup, and all these things are part of that spread between policy implementation and effect. And that's kind of what I think Besant and Trump have talked about. And I think that they're very objective and very upfront about the fact that there's going to be some pain in order to kind of restructure an economy and a system that's been completely broken. And these are two things that really should stand out, because housing as a source of wealth and a source of income, not income, but a source of wealth for individuals in the country, and retirement, and consumer spending driving the economy. These are two things that are really not as healthy or nearly as healthy as they need to be for the economy to be kind of firing on all cylinders, and we're not.
Right.
I think
And see, this is This is where, I think it really gets, I think, heavy into your world, Anthony, where, as you said, this is an economy driven by consumer spending, right? Somewhere between 2/3 and 3/4, depending on where we are in the year, is of the economy is going to be consumer spending. And so as you start to realize all of a sudden that, these corporations are not going to be selling what they thought they would, because consumer spending is not going to be what we thought it would be, that's when you have to really start reevaluating, I should say, do these equity prices make any sense anymore?
And that's when you look at the growth numbers and what the earnings look like. And I'm obviously a technical trader, and I don't really look at cash flows or earnings estimates or the balance sheet. But if you look at the breadth of the market and where earnings growth was coming from, when you start seeing 60%, 65% of earnings growth looking forward, so forward numbers out, concentrated in 7 names out of 500 in the S&P 500, you start to worry about, is there actual growth? Is the economy actually a real economy pumping, or are we kind of really dependent on AI? Are we really dependent on the Mag 7, which we have been? If you look at this chart, that line to the left, that vertical date line is August of 24. That was our 10% move down in 2024. So our correction. Now, people aren't saying it was a correction because it was 9.8%. I'm marking it peak to trough 10%. We'll call it a correction. We've had a decent run from that low. And what I've done here is I've run another Fibonacci retracement series from that low to the peak that we saw recently. Where we are now after that 10% move down recently, we've rallied back about 5.5% to the peak. So we've taken back almost half of that move. And we've hit our head now at the 38% retracement level. So we kind of were hitting resistance in the index around the 5,700, 5,750 level. And I wrote I've been writing in the reports that level up through 5,900 should be resistance, should give us some trouble. Now, what we're seeing is the tariff conversation's not going away. We're seeing momentum and trend, although they've improved on the daily. So we're just talking about the daily count now, which is the short term. They did improve. They're starting to slow down a little bit as we're hitting a retracement level resistance, as we have 2 days ago, and I noted it in my report, this little doji formation, which is a very tight open and close and kind of long tails to the high and the low. So market opened, went up, went down, and ended really close to where it opened. So indecision, kind of like a fade type stick. And the Japanese candlesticks are wonderful. That pattern needs to be confirmed. And what we're seeing is that pattern's being confirmed. So indecision at a retracement level after coming back, counter trend rally, about 50% of the sell-off. We're now breaking down below that big red rectangle. That's the topping pattern that I had marked out from back in December. That's not new. Breaking below 5,700. Cash index closed today at 5,693. Momentum starting to slow down. Trend is starting to slow down. And keep in mind, I continue to say, even though the motor model had shifted to positive on this counter trend rally, and I've written this and I've been writing it, I've decided not to be long on this rally. And I haven't been long on the rally for a very, very simple reason. What I'm seeing in the intermediate and the long-term model, because I can run my model on any period, is a real breakdown in internals. Momentum and trend are giving way, they're breaking. So we can see what that tells me is on the daily, we'll see some decent moves, but the overall market structure, the intermediate to long-term structure has changed. There's been enough damage done where I believe the greater move to come, the greater risk is skewed to the downside. So I don't want to participate in these bear market rallies and then have a day like yesterday and kind of get hurt on a real sharp 1.2, 1.3% sell-off. I would rather wait through these rallies knowing that these rallies are short-lived. They're going to be aggressive. They're going to be short-lived. There's going to be short covering. There's going to be chasers. There's going to be guys that still think you buy the dip because that's worked for 15 years. I'd rather be there ready to let some stock go and get short on the way back down for the S&P. That's going to be the bigger trade. I do firmly believe, and I wrote this morning, that if we break below and close 5,700 now, so fading back down, which we did today, tomorrow will be our confirmation day. I do believe it will be an aggressive move to 5,500, which was our recent low. And I do believe, based on everything I'm seeing, that we will, at a minimum, in the S&P 500 cash, see 5,000 before this move is done. And I think we'd be lucky to get away with just 5,000. Tariff conversation aside, GDP, the consumer, interest rates, the 10-year, I think it all plays out to a 20% move down, peak to trough in the S&P. And if that's all we get, we should consider ourselves lucky. I would say that I don't think this is something that President Trump and Mr. Bessent are afraid of. In fact, I think they're looking for it. Not that they're encouraging or rooting the market down. I'm going to shift a little bit I'm going to pontificate for 1 second on where I think they are. The reason I say that they're not afraid of it is because they've said they're not afraid of it. No other administration that I can remember, whether it be the Treasury Secretary or the President, have said there's going to be pain, have said if the market goes down, markets go down. If there's volatility, there's always volatility. I mean, honestly, our Treasury Secretary put on one of the most iconic trades in history. It was a FX trade in the British pound. He understands markets. You can't argue that. Mm-hmm. And I do think that if the market was to come down, and now I'm going to ask you a question with the end of my pontification. If the market was to fade, and everybody likes to say President Trump likes to look at the stock market and he uses that as his measure. And he did. He definitely did. Trump 1.0 loved the market. And Trump 2.0 loves the market as well. But very well-rounded here and understands the bigger picture. Very similar to Reagan, to be honest with you. If the market was to fade, in my opinion, what would happen is we'd see a slowdown in spending. We'd see a slowdown in inflation, and everybody would start to tighten up the belt a little bit. That would actually help in a few ways. If the market fades, I would think that the Treasury could issue less 10 years, loosen up regulations, and that would create a demand for a 10-year duration. If they create a demand for the 10-year duration even further, yields come down on the 10-year. That's going to lower borrowing costs as people are actually spending less and tightening up. As Doge and the government is cutting deficit spending and debt, tightening inflation more, lowering inflation more, it's going to lead to a slowdown. It's going to lead to a recession. However, at the same time, we have the market come in, we have rates coming down, we have spending slowing, but we have corporate spending coming into the country. We have onshoring and reshoring of businesses. We're looking at trillions of dollars coming back to the United States. The tariff conversation plays in here with the onshoring and the production of goods back in the U.S., whether it be autos or steel, aluminum, farm goods, what have you. As we come through that recession, in my opinion, all these things will set up for an uncomfortable year to year and a half. And then what we'll see is a real V-shaped recovery where this economy will explode in 12 to 24 months from now. But I think a down market, down 20%, 30%, is actually something, again, I don't think they're rooting for it. I don't think they're afraid of it, though. What do you think of that?
I think you need to write that up for a doctoral dissertation. That was absolutely fabulous, Anthony. I mean, soup to nuts. I love it. Not necessarily because I'm rooting for it, but I just love it because I think everything you said is spot on accurate there. I think that's exactly the kinds of market conditions we're facing. I think that's exactly what these different players are thinking, right? That's what's going through their heads. That is what they've said. And you're right. I mean, and if I remember correctly, I think Bessent pulled off that trade on the British pound before he was even 30 years old.
He was young. I mean, that was 92, I think.
So I mean, the guy's an absolute genius when it comes to sovereign debt markets, right? There's no doubt about that. He is the right man for the job. I think everything you said on the 10-year, again, is spot on. I think everything you said about the market is spot on. Look, at the end of the day, we are due for that, I think, correction. I think it would be healthy. And I think what you're talking about in terms of those market moves having effects on individual behavior, on consumer spending, whatever the case may be, I think that's also spot on. It's interesting how, when we look at like the consumer confidence numbers and we break it down by age, and we look at the oldest cohort, 55 and older, those are the people who are typically most sensitive to market moves because they're getting closest to retirement. And so they're getting really anxious about about watching the market. Now, that obviously begs the question, if you're that anxious about market moves, maybe you're so old that you shouldn't have so much in the market, right? But whatever the case,
Fair enough.
maybe you need Island Capital managing your money and not, not Joe Schmo from Wells Fargo or Bank of America down the street. Whatever the case may be, though, it's pretty clear that the volatility in markets today is having a big impact on that 55 and older group. And so I would not be surprised if, as the market, the market has already gone down, if it goes down more, we see that group then really start to rein in their spending. And they say, you know what, maybe I shouldn't be so leveraged. Maybe I do need more money for a rainy day. Maybe I should be paying down my debt. I think the younger cohorts and those that are already deeply in debt, although there's a lot of overlap there between those two groups, the young and the deeply indebted, I think those are the folks who are not going to care as much about the market, who are not going to be that affected by the market, by equities going up or down. In fact, for a lot of them, I think it's probably a positive. It creates buying opportunities for getting into the market for equities, buying opportunities for getting into the market for a home.
Yeah.
I mean, it's amazing how many young people today have literally given up, Anthony, on the idea of ever being able to afford a home. Yeah. And Powell is not going to budge on interest rates, I don't think. So probably the only option that these folks have is if home prices do preferably come down, but at a minimum flatline and stop the rocket ship appreciation that we've seen. Yeah. So, I think everything you outlined there, that whole analysis is spot on. I think that a downturn in the market would not be unwelcomed by this administration. Again, they're not necessarily rooting for it. They're not cheering on a bear market, but they are more than willing to tolerate one in order to get us to the positive economic outcomes that we're looking for. This is the first time in probably both of our lifetimes, I think, that we've had a president who was saying, you know what? Let's do it. Like, we are more than willing to go through some short-term economic pain to get long-term economic gain. I mean, even Reagan wasn't really willing to talk about it in that way. Reagan talked about how the government needs to go through a lot of pain, right, in order for the private sector to grow. But I mean, again, in our lifetimes, I don't know if we've ever had a president talk about it this way, where he talks about, look, there's going to be an adjustment period. This is real. There is going to be some short-term pain. I don't know. There is a certain there's a certain masculine energy, frankly, to the way these guys talk about it. Like, look, we're gonna have to go through some tough reps and some tough sets here in order to get the outcome that we want.
Yeah, I would say with the market, part of the problem with the younger generation, and yes, they have time on their side, and yes, it presents opportunities to buy for the longer term. Most of the younger generation, so if you were born, I was just talking about this with somebody today, if you were born after 1990, you really don't know what a real bear market looks like. You're used to, meme coins and Bitcoin and Dogecoin
Right.
and GameStop, and you're used to this buy the dip and it keeps ripping, buy the dip and it keeps ripping. They did experience potentially COVID in 20 for some of the guys, and gals, but the traders and the younger and the guys, particularly the people on their phones trading in whatever at Robinhood or TD Ameritrade, whatever they're using, they don't understand how this works. So my fear is that at the end of the washout, they will have very little to invest because they will have been washed out and spun around so many times. They won't really know what to do with themselves. And that's a real important thing. To your point about, I think, Joe Schmo from Wells Fargo, I was listening to a Fox Business morning show yesterday, and one of the guys who was saying that the market was not overvalued and wasn't going to fade and we were going to hit new highs 2 months ago was now saying that the market is fairly valued. Keep in mind, we're 6% off of the peak, okay? We're fairly valued, and I'm almost quoting him here. This is going to be a buy anything you want, rip your face off rally to new highs. So I would just say that we were overvalued at the peak. We're 6% down. Let's be realistic. Let's just take a breath. We have not come to fair valuations. If we were overvalued at the peak, 6% higher, we are still overvalued. The air is just starting to come out of the balloon, in my opinion. So the guys that are constantly rooting for that win, constantly rooting for those new all-time highs, constantly talking about, exponential growth out into the universe and all, just take a breath. It's time for us to come in. It's time for us to at least acknowledge that there are reasons to believe that we're going to come in and we're going to come in further. I will say one more thing, and then we're going to go to how stupid it is, because I really love this segment.
The best segment.
The tariff conversation is getting really interesting. We had some more back and forth today between Carney and Trump, or I think it was just Carney yelling into an empty box and hoping that Trump would respond type thing. But April 2nd is the day, right? That's Liberation Day. We're going to head into reciprocal tariffs, which honestly, for any developed nation to be complaining about us looking to raise tariffs on them, we are by far the country with the lowest tariff levels across the board. So everyone should just calm down. I do think everyone's missing something in the tea leaves, and I'm going out on a limb. I said it to a few people yesterday, today, and they think I'm crazy, but I'm used to that. Treasury Besant said at the White House the other day, and I'm quoting, talking about tariffs and April 2nd, the number that the tariffs that they're going to put on, the number that we believe that represent their tariffs with all trade partners. So that, in other words, the tariffs that the White House is looking at is the number that the White House believes represents the tariffs with our trade partners. The point I'm getting to is, I don't believe, so let's say consumer goods from Canada are up to 45% tariff on Canada from Canada. I don't believe they're looking at 45%. The number that the White House believes the tariffs represent is that 45% plus the non-tariff barriers. And I don't think everyone's getting this. I think there is I don't want to say a black swan event on April 2nd. I do not think that next week, in my personal opinion, and this is just a theory, I have technicals behind the fact that the bigger move is down. This is just a theory. I believe next week is not going to be the U.S. is going to play nice. The U.S. is going to give a break. The U.S. is going to make it okay. I believe next week is going to be a hammer dropping on anyone that hasn't come to the table to say, what do you guys want? And we are willing to play ball, is going to have a sledgehammer dropped on them. And I do believe it could be a very negative catalyst for the market. Could it be a positive catalyst? Yes. But where we are right now, what I'm seeing and what I think is going to happen, again, the negative catalyst is way outsized compared to what we could see to the upside, all in, all considered. So I'd be really careful heading into April 2nd. I'd be really careful getting long for a kumbaya moment as far as tariffs. I don't think that's what the White House has in mind by any stretch. I think it's actually the opposite.
And maybe it takes that hammer dropping moment, right, Anthony, in order to actually bring folks to the table. I mean, so some of these countries are already bending the knee, but some are just downright obstinate. And maybe it's going to take, not only the threat of these tariffs, but actually seeing their export markets start to crumble before they're going to be willing to come to the table. And that does mean disruptions in the near term, and that means volatility in markets, whatever the case may be. One thing I would love to get your take on, though, but before we get to the greatest segment, the stupid segment, is what is something that you're going to ultimately be looking for as an indicator of, all right, the market is turning around? In other words, what input has to change that's going to shift your modeling from being more bearish to being more bullish? And I'm not asking when is that going to happen? No need to pinpoint a date for me. I'm just thinking here, okay, what are the things that are ultimately going to lead you to and lead your model to shift again away from bearishness and maybe towards being more bullish?
Yeah, I could go through next week. I'll give some exact levels, but essentially what I'm going to look for is I'm going to look for previous support resistance levels lower in the market, getting tested and holding as I start to see the short term, the intermediate term, and the long term indicators that I mark in my momentum trend model start to stabilize at a minimum or improve. So essentially what I'm going to look for, and bottoms are different. So let me pause 1 second. Bottoms at capitulation are normally different because they could be very aggressive and more of a V versus a basing formation and a work out of it. What I'll look for is the exact opposite of what we've seen at the top. I'll look for all of my periods, daily, weekly, monthly, starting to improve or at least hit a neutral as the market has hit levels which make sense as far as depth of sell-off and as far as previous support or resistance. That could be retracement level, that could be previous major support or resistance. What I would love to see is I'd love to see a retracement level for the entire move. And for me, I'm using the COVID low. I'd love to see a retracement level for that entire move, overlap with previous resistance or support, lower in the market, down 20, 30, 40 from here, and then have internals start to improve daily to monthly, to daily to weekly to monthly. So all of those things will come into play. And like I say all the time, and I do mean it, it's not if we hit lower levels, it's how we hit lower levels. So a lot of times, like I was talking to a guy today who's been a friend for a long time over at Bank of America, and he's like, well, what's your downside? What's the next downside in the market? My next downside in the market is 5,000. So then the next question is, okay, do we hold 5,000? And I'll say the same thing. It's not if we're going to hit 5,000, in my opinion. We will hit 5,000, in my opinion. But it's how do we hit 5,000? Do we hit 5,000 on a large spike down with massive volume and then a large spike up the next day with a reversal stick, massive volume, things start to really improve? Okay, that's a different look. Do we hit 5,000, start to grind, get a little pop, momentum is still bad, trend is still bad, volumes start to lighten up on that rally, looks like a short cover rally, looks like there's more to come from on top. Weekly still looks bad, monthly still looks bad. That's not my low, that's not my buy. And I would rather be buying in up 10 to 20% from that low than get in and try and catch a falling knife and then have my face ripped off for another 10 to 15%. So we want to find previous support or resistance. We want to overlay that with retracement levels. And then real important, we want momentum trend, the motor model, to pick up on a daily, a weekly, and a monthly improvement in the signal, whether that be a shift from negative to neutral or whether that should be a shift outright from negative to neutral to positive. We want to start to see internals improve off of what makes sense as far as a support level. And part of that, I'll finish with, is the depth of the sell-off. For people to say a 10% correction is over, we get them, all the time and don't worry about it. That's not, somebody the other day said, well, we had capitulation, so we should have hit the lows for the year. And he's actually a CMT, and I was listening to him on TV. I don't remember ever considering, learning, or thinking that capitulation, absolute, a puking of everything you have, happens down 10% from all-time highs. It just doesn't work that way. And I would remind everybody on a real quick separate note, we have had over the past 4 years, so this year moving backwards, 10% sell-off, 10% sell-off, 10% sell-off, 28% sell-off. I also don't remember how many times in history, and I've been looking and I haven't found consecutive years like that. I know we've had consecutive monster gains net, but I don't remember the sell-offs that deep and that consistent year over year over year over year in the past. That to me is also interesting at this point. I think it's feeding into the fact that this thing has just been waiting to deflate for the past 2 years, really.
So we have a lot to keep our eye on, in other words, and it's not going to be a simple one-off. It sounds like it's going to be quite some time before we get enough data coming in that's consistent in one direction to change the direction of the output of the model.
Yeah, absolutely. And I'm okay trading through, and obviously the portfolio effect of being long certain things like gold and then being short the S&P and the Russell and then trading through crude signals, like everything kind of works together. But there's a lot to look at. There's a lot to watch. And, the timing of the market discounting the economic reports and the economics of it is always tricky. So being aware of all that, lot to look at. I do overall think that the greater risk to the market is skewed to the downside, and that's where I stand. When my data and my models tell me that I should change my view, I will, but I haven't gotten that yet. I've had that view since December, and it's been working out pretty well so far. So until it changes, that's where I'm going to stay. Great question, great conversation. I love the consumer part and the housing part, EJ. Really appreciate that. I have to go into the segment. I'm going to be very quick and to the point with Jeffrey Goldberg. How stupid is Jeffrey Goldberg? That is that's the How Stupid Is segment for this week. I find it so hard to believe that anyone in this great country would work so hard to attack and break down the success of the country. I almost find it treasonous that he would have somehow gotten into that chat. And honestly, I don't have a conspiracy theory on it. I'm just curious as to how exactly this happened. It seems a little odd to me, but I'm so taken back by the fact that this man decided that his moment in time to try once again to embarrass or break down the Trump administration, or to put soldiers in danger, or to jeopardize our standing and our strength on the world stage was important enough for him to release whatever he saw in this chat. And let's keep in mind that this chat had no names, no locations, no routes. There was nothing in there that was privileged or would have created a situation where there was privileged information released, and at the same time it occurred on an approved device. So everything that was done correctly. Our administration, our cabinet is entitled to have these conversations on what has been approved as a locked device, a secure device. The fact that this guy is trying to get another 6 minutes of fame by creating a problem for not only the administration of the country is an absolute disgrace. I think he is an absolute low IQ, low performing human, and he should be ashamed of himself.
Well said. It's like all these guys think they're going to be the next, the next Deep Throat or whatever. They all think that they're going to break some big scandal, and it's never the case. I mean, it's amazing how many of these, clowns, frankly, like you said, these low IQ individuals think that they're going to be the one that nails Trump or whatever. I mean, we had the entire intelligence apparatus of this country turned on him for how many years, and they couldn't find anything on the guy. Somehow the former Atlantic City casino owner is squeaky clean. It's incredible, but there it is. And you're right. I mean, these people are putting, they're essentially putting law enforcement, they're putting national security experts, they're putting military folks in harm's way when they do this nonsense. You're absolutely right. It's incredible. How stupid can you be? Maybe we got to change the name of the segment to how prideful can you be to think that you're going to get your next, like you said, your next 5 minutes of fame doing something so stupid.
Yep. I think if you hate this country that much and you're that deranged, buy a ticket. I'll buy it for you. One way, go wherever you want in the world. Maybe Rosie O'Donnell has some room in her house in Ireland. You can head out there. But honestly, pack your bags and leave. You're not needed. You're not wanted. And I mean that. Everyone in this country should be supporting this country. This country is the greatest country in the world. You should be a patriot. You should love this country. You should look to support this country and this president. And if you're not, you can exit stage left, in my opinion.
Amen. Although I will say, I don't know if there's room anywhere that Rosie O'Donnell already is. So, but other than that, I think you're spot on.
Love it. EJ, have a great night. Thank you.
You too, Anthony. Until next time.
Talk to you next week.